Hey, I'm Abe, and today we're going to talk about the 401k retirement account. What is a traditional 401k? It is a qualified retirement account, which means that it is given special tax benefits by the IRS. A traditional 401k is often an account type that is offered by employers. Within that account, generally each employer will offer a small, limited selection of mutual funds that you can choose to invest that 401k money in. Those mutual funds will often include target date funds, which are specific to the date that you plan to retire. And it'll also have a number of other options that cover local markets, international markets, and just a limited but broad selection of investment options so that you can pick and choose and create a portfolio that is both diverse and sets you up for success in the long run. Generally speaking, 401ks and other pre-tax accounts like the 401k, and when I say pre-tax account, I mean that before the IRS knows how much you make at the end of the year, money that goes into your 401k, whether you're doing it intentionally and actively, or whether your company is just pulling it out of each of your paychecks, that money comes out before your income tax is applied. So it is considered a pre-tax contribution to your retirement account. Pre-tax accounts like the 401k are used if you think that your income during retirement is going to be lower than your income right now. Right now, and that's a good assumption. Right now, your income, and for the rest of your career likely, your income is going to be as high as it probably will be. And the later you get in your career, the higher and the closer to the max of your overall income you will be. I'm going to use $100,000 as your income as an example because it's a round number. So if you would have at the end of the year earned $100,000, you want to contribute $10,000 of that to your 401k. Your taxable income come tax time will be $90,000. The IRS doesn't know, or at very least doesn't care about that other $10,000 yet. That isn't to say you won't ever pay taxes on it, but while it is in that 401k account, you will not be charged capital gains tax as you sell different assets that you're invested in and invest in other ones. You will only get taxed on it when it gets withdrawn from the account. There are some limits to this account, and as with all accounts that are earmarked as retirement accounts by the IRS or qualified accounts, because they're being given this special tax treatment, they have limitations about how much you can put in, when you can withdraw, and that sort of thing, much like the Roth IRA and the overview that we did a week or so ago. The limits for a 401k, you are limited in your contribution per year to $19,500 if you are less than 50 years old. Over 50 years old, you are limited to $26,000. And the difference gives you the ability to catch up if you are later in life on your retirement savings and planning. In addition to your personal contributions to the 401k, your employer can make contributions, and you can choose to make additional after-tax contributions as well. There is a limit to the amount that in total can be applied to this account in a given year, after you've done yours, after your employer has done theirs. And that limit, if you're under the age of 50, is limited to $57,000 or 100% of your overall compensation as an employee, whichever is lower. If you are older than 50 years old, the limit is $63,000. Employer matching, to get into the specifics of that, often works in a way such that they will match what you put in up to a given percent of your income. So if you make $100,000 and your employer says they will match your contributions one for every dollar you put in, they will put in $1 until 4% of your income, that means that you have to contribute $4,000 in order for them to contribute $4,000. Anything else that you want to contribute on your own is fine, but your employer's contributions aren't done. Some employer matching is limited to 4%, some is 6%, some employers don't match at all. So if you are working at your company and you are unfamiliar with your company's rules about how they manage their 401k, definitely go in and check it out. This is a benefit that companies offer to supplement your income because they're basically giving you, I'm not going to say free money because you're going to get taxed on it at some point, but they're giving you money that isn't a part of your salary. If you can, take advantage of as much of their contribution as you can. Contribute as much as you need to get them to max out whatever they're willing to contribute. As with a Roth IRA, there are limitations to when you can withdraw money from your account and how that happens. You have to be 59 and a half years old, and your earnings are tax deferred and will be assessed on that withdrawal. So after you're 59 and a half years old, if you decide to withdraw your money, you will be taxed on that withdrawal as though it were income. Along with those restrictions, there are also required minimum distributions, or RMDs as they're known. These are mandatory withdrawals that after you reach a certain age, with the 401k, and as of 2020, it is the age of 72, a certain percentage of the overall value of that account, of your 401k account, needs to be withdrawn each year. That percentage is determined by a table that the IRS keeps, and it takes into account the quantity of money in the account, your age, and a number of other things. If you are about to be faced with this required minimum distribution, then you should definitely look and figure out what that percentage is. Maybe talk to a CPA or an accountant and ensure that you are withdrawing what you need to withdraw, because there are penalties involved. There are also penalties involved if you need to or desire to pull money out of your 401k prior to you turning 59 and a half years old. This goes hand in hand with the fact that it is a qualified account and has these advantageous tax benefits that they want to make sure that this is really primarily and only being used for retirement planning. When you leave your company, the 401k account is often tied to whoever they've selected to help them handle this aspect of their business. And when you leave that company, you will have 4 options of what to do with that 401k and the money that's in it. Your first option is to withdraw it and not place it in another account. Generally, that's considered a bad idea. You're going to incur a bunch of taxes and penalties or fees, especially if you're under the age of 59 and a half. Your second option is to roll it into a traditional IRA. This is a very similar account, and we'll talk about this later this week. But by rolling it, you're taking the money out of the 401k, you're putting it into a very similar account that is treated similarly with respect to taxes, and funds that are withdrawn need to be rolled into a new account within 60 days. Otherwise, you then incur those taxes and penalties that we were talking about earlier. Number 3, you can leave it with your old employer in that 401k account. The money is still yours. Everything you've invested in is fine. You can't contribute any more to it in that account, and you can't take advantage of their other options, but you can leave it there. There are some provisos or caveats to that where if it is a small enough amount of money, your employer can force you to take it and do something with it, whether that's roll it over or whatever. It's up to you. But if it's a small enough amount, they won't want to incur the cost of maintaining your account and will force you to withdraw and take it elsewhere. The fourth option is to move it to your next employer's 401k account and then just invest it into all of the mutual funds and assets that they have available to you there. So those are your 4 options. That summarizes what a 401k is, and the 2 things that you should take away from this are, 1, that you're putting pre-tax dollars into it, which means you are putting money in that you have not paid income tax on, and in doing so, you're reducing your current tax liability. Each year that you do this, you are paying fewer taxes now than you would have. And because, at least in America, in the US, the tax is a graduated scale in that you pay a certain percentage of tax on the first X dollars of money, and then if you make more than that, you pay a higher percentage on that next block, and then a higher percentage on the next block, and an even higher percentage, and so on. So if you can reduce your taxable income, you're reducing the highest taxed amount of money, and you're saving yourself money now, and you're delaying that tax liability until your income is much lower, so you can pay lower taxes on it. And secondly, the most important part, I think, is if you have a 401k where your employer is matching, this is free money, essentially, that you can get from your employer in addition to your compensation, in addition to your bonus structure and everything else. Do what you can to get your employer match and then figure out where you want the rest of your money to go. This is the 401k. We learned about the Roth IRA on Friday last week, which is an after-tax retirement account. This is a pre-tax retirement account. The traditional IRA will be very similar to what we talked about today, and we'll talk about that probably on Wednesday. Thank you for watching. Hit me up with what questions you have, and I will see you in the next video.